People often wonder what's better, capital appreciation or yield. If yield was better, nobody would invest for capital appreciation. But you invest in prime areas even though they don't have much yield or as much yield, because over time, that's how you generate the bigger returns. But the investors that buy prime assets, where you do get these low yields that are only 3 or 4%, they don't use debt, well, they don't always use debt to buy those assets, because they'll go to their private bank for something called a Lombard loan, and they'll say, "Dear Mr. Private Banker, I'm worth $100 million. I'd like you to lend me $30 million, and this is what I'm going to use it for." So they don't need the debt on the asset, which is just as well, because the yield is only 3% and it couldn't service much debt. It couldn't pay for much debt because the yield is too low. So typically your prime real estate assets are for your high net worth and your ultra high net worth investors. And the reason they invest in those areas is because over time they should appreciate better than your secondary locations where you get better yield, and they should generate bigger returns net. And most portfolios would end up having a bit of both. Maybe the home that you live in is prime and it's going to give you the capital appreciation, but if you rented it out, there'd be no yield. And maybe your investment portfolio is giving you terrific yield. So sometimes you want a bit of both. You might want to go 50-50, 60-40, 80-20, really depends on the individual, what the rest of their portfolio looks like.